Okay, welcome to our 15-2 notes. So in 15-1, we completed our income statement and did component percentages. So now we're going to actually put those component percentages to use. But for them to actually be useful for our business, they have to know what's considered acceptable for their business. So for each type of business, it's going to be a little bit different what would be considered acceptable. And there's lots of different places as a business owner that you can look up to see what's acceptable, or the longer you've been in business, you can just compare yourself from year to year. Now, obviously, our main concern, or just kind of assigned to us, is when they would be considered unacceptable. And so these are serving as a warning that management needs to take some type of action. They need to do, they need to do something differently. So now we'll kind of look at each of our different component percentages, and then kind of what could you do if they aren't acceptable. So we'll start with our cost of merchandise sold. So this is typically for a merchandising business, or it should be, pretty much your major cost. And to be successful and make some money in your business, we want to keep this as low as possible. And so for it to be considered acceptable, it should be less than or equal to our actual acceptable component percentage. Then we have our gross profit on sales. And this, we need it to be large enough that it's actually going to cover our total expenses, as well as hopefully getting us some net income, making some money. And let's see, this is hard to see. Move myself up there. Okay. And then when we're looking at it, it should be greater than or equal to whatever is considered acceptable. Then we have our total expenses, and total expenses should be less than our gross profit on sales, because this goes right along with it, so that way we get a desirable net income. We would hope it to be less than or equal to whatever is acceptable. And then lastly, our net income before federal income tax. It shows the progress being made by a business, and we need it to be greater than or equal to the acceptable component percentage. So then now that we know how to determine if it's acceptable or not, we're going to look at if it's not acceptable, what are some things that our management team can do. So if we have an unacceptable component percentage for gross profit on sales, and really the only thing you need on your notes is just like this number one, increase sales revenue. The rest is just kind of for your information. So one of the things we can do to get that back into our acceptable range would be increase our sales revenue. And so to do that, we might have to consider increasing the markup on our merchandise that we are purchasing for sale. So charging our customers a little bit more. That's one thing we can do. Then just write down number 2, decrease our cost of merchandise sold. So how might we do that? We could do that simply by having our management review their purchasing products. Are we buying too much of something at a time? Do we have too much in stock? Are we having a lot of stock that we're not selling and we just have to hold on to? And then the last thing is maybe we need to do both. Maybe we need to increase sales revenue as well as getting that cost of merchandise sold down. So those are things if our component percentage for gross profit on sales is not acceptable. Then we'll move on looking here at our total expenses. So if it is unacceptable for our total expenses, you're going to want to actually take a look at each individual expense to review it and see if maybe some major increases have occurred. So maybe your rent has went up and you didn't even realize it, or all of a sudden you're using way more office supplies. So really analyzing each expense to see maybe where can changes be made, where can I make cuts. And so that's what you would want to look at to see how can I reduce these expenses. Then if we have an unacceptable percentage for net income before that tax, typically if we bring everything else into check, because probably something else is off balance as well, this will then help us get into the acceptable range for our net income. Okay, then for here the last things in 15-2, we're going to look at a couple different financial ratios. So what is a financial ratio? It's a comparison between two items of financial information. Okay, so our first financial ratio, there we go, that we have is our earnings per share. So this is the amount of net income after our federal income tax that go with just one share of stock. So the formula for that is taking our net income divided by our number of shares outstanding. So the book will it will always tell you what your number of outstanding shares are, and that's going to get you your earnings per share. So how much is somebody who owns stock in your company making for each share that they own? So that's earnings per share. And then our last one here is our price earnings ratio. So this is the relationship between the market value per share and our earnings per share. So to calculate that, we take our market price per share, which the book will tell us, divided by our earnings per share, which that you just learned how to calculate, gets you your price earnings ratio. So that's all there is for the 15-2 notes, but a lot of this, you're looking at the component percentages from the work together and on your own. So if you did not get 15-1 done yet, you're not going to really be able to move on to 15-2. So then I'll post the rest of the assignments in Schoology and let me know if you have any questions.